This is the WealthNet Market Call of the Week, highlighting investment trends that could affect your wealth. Globally aware with a geopolitical and quantitative perspective.
Hi, this is Louis Yanis with WealthNet Investments. I want to introduce a three-part video that we're doing. And the three-part video is on a big topic. It's on the role of technical analysis in portfolio construction and position sizing. And the three parts are very distinct and they'll have different parts of the whole process. The first part is theory and practice of market risk. And in that first video, we're going to be talking about really just a general introduction about what technical analysis is and portfolio theory and what practitioners must adjust for to improve the risk-adjusted returns as technicians. And then we're also going to be talking about common characteristics of market shocks and how to uncover hidden risks in the market. So that will be the video number one. And video number two is going to be defining portfolio risk and position sizing. This one has a lot of meat in it, and I'm going to be talking about what is needed to develop a risk profile for a portfolio strategy and what correlation and three things that you need to look at in correlation that will help you have a more robust look at correlation between instruments that you're investing in. And then lastly, in that video, I'm going to be talking about the framework for effective position sizing, and I'm going to actually show a protocol for sizing positions. It's a very interesting flow chart. And now the last video, part three, is going to be integrating technical analysis in the portfolio management process. So what we're going to be talking about there is developing indicators of return, risk, and correlation, and standardizing those indicators and transforming those indicators in a way that we can develop trading outlooks that can be commonly held and actually worked in an interdisciplinary way, so we can work with fundamental analysis and macro analysis so that we're all speaking the same language. And we're also going to be talking about conditions needed to trade. So what are the conditions that help in that portfolio construction itself? Very, very interesting. And then finally, I'm going to wrap up and talk about the whole three videos at the same time. So I'm really interested in seeing your comments on this one. I hope you enjoy this. So let's dive into video number one. Hi, this is Louis Yanis with WealthNet Investments, and this is the introduction to part one of our three-part series about the role of technical analysis in position sizing and portfolio construction. Part one is about theory, practice, and market risk. So we're going to be talking about a few things here. I'm just going to have an introduction about the whole concept. I'm going to talk about portfolio theory and actual practice and the difference there, and some of the adjustments that we have to make as portfolio managers and technicians to get better risk-adjusted returns and to pursue that avenue. And I'm also going to talk about, really importantly, the common characteristics of market shocks and how to uncover hidden risks that are in the market. Very, very important part of the piece. Okay, so let's dive right in. Today I'm going to be talking about the role of quantitative technical analysis in portfolio construction and position sizing. Now that's a mouthful, but let me just dissect that down a little bit. Quantitative technical analysis is really the discipline of using numbers and supply and demand figures to estimate risk, return, and correlation of investment instruments. That's what it is. It's kind of statistical analysis, basically. And portfolio construction is the concept of how you put together and build the portfolio. It's kind of like when you build a house. You have a foundation, and then you put different types of wood and metal and screws and all that. And how you put that together, if you do it right, you have this beautiful house. And so portfolio construction is that process of building that house. And position sizing has to do with how much you put onto an investment. So how much money is allocated into each investment to make up that portfolio and how you put it together. This is what I'm going to be talking about today, and I'm going to go a little bit fast. There's a lot of technical stuff in here. If you have questions, feel free to let me know. You can comment below, shoot us an email at info@wealthnetinvest.com if you have questions. So let's just go ahead and dive in. So what I'm going to cover is, I'm going to cover how portfolio managers can incorporate quantitative technical analysis to determine portfolio construction, position sizing, and risk management. And I'm going to be talking about a high-level framework of how to do this using technical factors of return, risk, and diversification, or correlation, if you will. And I'm going to be really presenting this with the goal to generate target security weights, so a target amount that we're going to put into investments, and then tolerance bands around those, how far we're going to let those investments move away from their targets, and also trading actions, typical trading actions, and what would trigger them. So let's go ahead and dive in. We're also going to be talking a little bit about integrating, by the way, integrating technical analysis into our other disciplines, because we really are a multidiscipline operation. Our strategy and my real investment philosophy as I'm building this company has to do with a multiple discipline strategy. So we use fundamental analysis, we use macro analysis, and we use quantitative technical analysis in our approach. So we're going to talk about how we integrate that together. So one of my favorite sayings is by a guy named Yogi Berra. You probably heard of Yogi Berra. He said, "In theory, there is no difference between theory and practice. In practice, there is." And that's really, really true, because when you go to college, you get an MBA, you get a PhD in finance, you hear a lot of theory, and as you get into the PhD level, and I don't have a PhD, but I have friends who do, you get more practical, but there is a lot of theory. And what we're going to be talking about today is more about practice, using theory but turning it into practice, and that's something I want to talk about. So let's first start off with a little bit of theory. In basic finance, we always talk about this efficient frontier in the investment world. The efficient frontier is basically an optimization routine where we're trying to optimize the risk that we can realize in a portfolio of investments compared to the return. So theoretically, there's this optimal blend of investments that if you put them together, it should give you the highest rate of return given a certain standard deviation or variation in the investment. And so that's really kind of the starting point of most investment portfolio theory. And there's a lot of great concepts with this because it uses returns and standard deviation and correlation as its main inputs. It's very elegant, and statistically it uses parametric statistics, so it allows you to use probabilities and things like that. There's a lot of beautiful things about it. However, it doesn't necessarily fit what really happens in the real world. So what we're going to talk a little bit about is why that is, and then some of the adjustments to make. So first, if you look at this graph here, this is the normal distribution. Everybody probably has heard of that. That's that Gaussian bell curve where things are really nice and neat, and 68% of the observations are within one standard deviation of the mean or the average. And theoretically, if you look at modern portfolio theory, it kind of assumes that is the case. We know that that's really not how things work. If you look at a normal distribution, there's what's called a 5 sigma event, and that means 5 standard deviations away from the mean. How often does that happen? That happens like less than a tiny, tiny, tiny fraction of the time in a normal distribution. However, when you look at the real world, we actually see that there's a lot more times that actually happens, that you have a 5 sigma event. So how do you manage a portfolio given that? So what does that do? And let's just look at a little bit at the kind of the real data. In here I have a distribution, or what's called a frequency distribution, of the market returns in 40 different markets. And I used futures markets because futures markets are very, very non-correlated if you look at them, because you have stocks, bonds, commodities, and currencies, and there's a lot of different correlations there. So just to kind of show, really I'm trying to illustrate that these 5 sigma events happen in all the markets, not just stock markets or bond markets, or like it doesn't happen in bond markets or it doesn't happen in currency markets. And what I'm showing here is the number. If you can see here, there's numbers above each one of these bars. That tells you the number of occurrences that we've had certain sigma events. So for example, we had 26,656 days that were within 1 standard deviation, within 2 standard deviations, 5,685 days. And you can see 132 sigma events plus 5 sigma events, and minus 5 sigma events, 148. And that's a much higher probability than you would actually get in a normal distribution. So that's really the main point I wanted to make here, is we have these fat tails. So if you look at the data, we look at these 40 stocks, these 40 markets, and you can see that greater than 5% is 0.13%, greater than 5 standard deviations. So that's really something that we want to keep in mind, okay? And that's what I'm heading towards. And here's just a simple example of that. If you look at the Swiss franc, the Swiss franc recently, well, it wasn't that recent, it was back in 2014. It's not a unique scenario. We saw lots of 5 sigma events in the last 15 years. Here's one where the Swiss franc futures just had this huge move, and there was a big dislocation, and the futures in the Swiss franc had a big, big move in one fell swoop. Here's another example. There's an exchange traded fund that short the VIX. not my favorite strategy. Being short volatility is definitely not my favorite strategy, because you can lose money very quickly in a short volatility strategy. But here's the short VIX ETF, and you can see it went from $139 here, and it went down to $9. I mean, there was a big, huge gap. I mean, there was like no time to get out, really. I mean, that was just almost instantaneous, or it was an instantaneous decline. A 93.17% decline in the ProShares short VIX, symbol SVXY, that we saw back in 2018. I mean, that's crazy in January. All right, so even the blue chips. So you don't even have to have something exotic like a like a short VIX index. The blue chips, the Dow Jones Industrial Stocks. If you go back and look at these largest one-day gains and returns, you have multiple times where you have these big declines that are well outside the normal distribution. Okay, so I think we've kind of established that. So back some time ago, back in 2003, I was a contributing author in a book published by John Wiley called The Handbook of Risk, and I wrote a chapter called basically a converging correlation in market shocks. And really what my whole thesis was in that paper was that whenever you have a market shock, you tend to have correlation converge, where you have larger increases in correlations and all the assets tend to move together, and standard deviation or risks happen to increase at the same time. So what that means is that you don't get diversification exactly when you need it. And I'm going to talk a little bit about portfolio construction as it relates to that. But basically, back then I wrote a piece that really said what are the common symptoms of a structural market shock, as opposed to just a temporary thing. A structural, meaning it was an important structural change. And I just want to read from this, because even today you can see lots of the commonalities of when we have these market shocks. And these if you answer these questions, if you ask these questions of yourself as you're looking at the markets, it could really help you identify not necessarily if something is 100% going to happen, but it will tell you that the risks have increased. So let me just go through this. When a severe market shock occurs, there's usually a large supply and demand imbalance or lack of liquidity. And if you go down to the bullet points, here are some of the following things that we can look at, right, to see if there's a potential shock looming out there. Number one, large institutions have a high degree of concentration in a particular asset class. That happens a lot. Right now, I see a very high concentration in large cap growth companies in the United States. Last time that I can remember in my career it being like this was back in the dot-com bubble. Valuations are at similar multiples to the dot-com bubble. So, you want to keep that in mind. A relatively small number of investors or institutions are exposed to a market to provide liquidity to the marketplace. So if you have a lot of assets being concentrated with a relatively small number of institutions, that's a red flag, because any one of those institutions could have a big impact on the market. And we're starting to see some concentrations in the market as well. Look at the exchange-traded funds, for example. I recently did some statistical analysis. I don't have the numbers in front of me, but I'll just kind of summarize. The exchange-traded funds right now, something like, if you look at the top 90% of the assets, so like if all the U.S. ETFs out there, if you look at the 90% of the total assets, is with something like 14% or 15% of all the funds. So a very small amount of institutions have a huge amount of assets in the exchange-traded fund business. I won't mention any names there, but investors and institutions are using a large amount of leverage compared to capital employed to finance investment transactions. So if there's a lot of leverage out there in any particular area, that could lead to a big unwind. And if a big unwind occurs, then you generally have a period of illiquidity and a shock can occur. So I'm thinking about today, there's leverage out there. There's been a relatively big craze on using debt to finance risk assets. And, even some pension funds have been using a lot of debt. There's a lot of money that's involved in private equity is another one that comes to mind. So, whenever we see a lot of debt, that could be a problem. This is something we want to look at. Certain financial transactions remain really popular, even though they do not make economic sense or have very little margin of safety incorporated in their pricing. So, I just have to say it. Large cap stocks in the United States are in this scenario, in my opinion. Now, does that mean they're going to fall and crash tomorrow? No, not necessarily, because they can be strong relatively, and then they can continue to move higher for quite some time before they roll over. I mean, we saw that in the dot-com bubble. They went over for really, I would estimate, another couple of years before they actually, rolled over when they, the valuations got kind of out of whack. So if it's really popular, I'll tell you what's really popular right now. Indexing is becoming very popular. Investing in the United States is becoming very popular. Investors are really shunning, for example, the international markets, the emerging markets. You look at the asset classes out there. A globally diversified portfolio has severely underperformed just investing in the United States, just buying an S&P 500 fund. Now that is generally historically not sustainable. So we want to just keep that in mind. All right, so let's move on to the next one. A large group of investors begin to have a homogeneous tolerance for risk. So if you have a bunch of people saying, I basically am feeling pretty good, or I really feel like the market is great, everything's fine, if we get complacent, that's not a good sign. All right, new regulations are implemented that affect the ability of institutions to invest in a certain type of asset class. So if we have some regulation that comes into existence that's really going to affect a certain asset class, that could immediately have an impact and a market shock could be exacerbated. Okay, the marketplace develops a common expectation about the future prospects of an investment or a group of investments. All right, it's a very similar concept, but if everybody is thinking X, then X is probably not going to happen because everybody's already moved their money in that direction. And that just makes total sense. There's a limited amount of capital that's out there, and if everybody thinks the same thing and they've already put their capital in that direction, then who's left to buy or sell? Makes a lot of sense. And this is a common kind of sentiment analysis that is used by technicians. All right, and lastly, and this is one that's really important, monetary or fiscal policy changes. In particular, if you have an abrupt change. Like right now, we're seeing a relatively new policy change. Monetary policy is easing has stopped, and now we're not easing anymore. That's important. We really need to know that that's important. That is changing the game. If there's a lot of leverage being used, there is a point in time when rates going up a certain amount will actually affect the liquidity aspects and the investment decisions, the capital employment decisions, and therefore the liquidity in the market. So we should take heed to that. All right, so now I want to talk a little bit about volatility and correlation characteristics. This is something that is really near and dear to my heart. Volatility is just, again, that how much do the prices move up and down, and correlation is basically a measurement of how close do assets tie together. Are they moving together or are they not moving together? Are they moving opposite together, and to what degree? So we can put that into a statistics between 0 and 1, or between -1 and +1. It's a very transient statistic. It's not always stable. Some relationships are more stable than others. And I want to get more into why we should expect the unexpected and how we can construct our portfolios, think about our portfolio results. So first I want to go and look at this chart here at the S&P 500 because I just want to make a point about the actual standard deviation, the realized volatility that we see. And my main point is that it's unstable. This chart here goes back to 1972. And it shows the S&P 500 rolling one-year standard deviation returns. And that's what you see in this bottom chart. It's that blue line. And what you see there is you see that it's not stable. It really moves up and down quite a bit on the volatility side. I mean, and the other thing you want to notice is typically you see big peaks in volatility when you have massive declines in the market. And that just goes to my point that I had mentioned earlier that, we lose diversification when risk goes higher. And when you need it the most. So that means there's a need for actually managing beta in the portfolio. Okay, so there we go. So risk is not stable, and so we have to have some sense about when risk is higher than normal or lower than normal, and whether or not risk is rising or decreasing. And technical analysis can help in that analysis. So to get back to that point about not having diversification when you need it. Back in that book, the Handbook of Risk book I was telling you about that I contributed to, I showed this graph here, and this is showing the volatility between the United States stock market and the EFI index, which is the International Developed Markets Index. And this chart shows back in 1971 to 2000. So this was done quite a while ago. And you know what's interesting is these statistics, and I'll show another chart, these types of correlations and effects still are in existence today. You have a situation where when volatility is increasing, so is correlation, and when it's decreasing, correlation is decreasing. So they're related to each other, and that generally is not good from a diversification standpoint, in particular with equities. Okay, I'll just show some statistics here. It shows the percentiles. This is a 60-day rolling returns, a diversified mix, or rolling correlations of 40 liquid futures markets, the same futures markets I showed before, and you can see that the average correlation is way different than the 90th percentile. I mean, sometimes it's twice as high, right? So what do we do when correlation is moved higher? So there's really three things that that we look at when we're looking at the co-movement of assets. Number one is it what's the statistical level? Is it high or low? So does it tend to be high or does it tend to be low between two asset classes? If they tend to be high, then they tend to move together, then we need to be careful about putting too much in grouping them together, right? And then we also want to look at not only the statistical level, we want to see how stable it is. Is it loose? Is it stable or is it unstable? So, and I'll show a chart in the metals basket that we recently discussed about how a couple of the metals relationships are pretty stable and some are not stable in the correlation. So, and we want to look at that correlation stability over your time horizon. So if you're a longer term investor, you want to look at longer term data. If you're shorter term, you want to look at shorter term data. So we want to look at the statistical level and then the stability. And then lastly, in correlation, we want to look at the logical. This is probably the most important part. What are the logical fundamental drivers that will actually indicate that this is a logical correlation relationship? You can have a lot of spurious correlation. It goes back to that old concept of what is, correlation does not necessarily mean causation. So we have more confidence if we have strong logical fundamental drivers and we have statistically high stability in a relationship. Okay? So basically what we're looking for with correlation is overlapping fundamental drivers. So when you're building a portfolio, constructing this portfolio, you want to know to what degree are there overlapping fundamental drivers, because if there's a lot of overlap, then that is more risk. If there's less, that's less risk. Okay? So here is that metals basket that I was telling you about. This is a rolling 30-week correlation of returns going back 5 years, ending in November of 2018, November 3rd of 2018. And it has a basket of gold and platinum and silver and palladium. So there's 4 here, and we're looking at the correlations between those 4. And you can see we have high stable correlations between these top 2 lines here. They're both relatively high, and they both kind of stay close together, right? And those would be, your relationship between gold and platinum, and it would be your relationship between that other one is silver and gold. So, but notice here what you see with the other ones here, the low correlation, the loose ones. What you see here is platinum and palladium, and silver and palladium are very, very loosely correlated, and they're volatile. They're not stable. They're all over the place. So that tells you a lot about palladium, right? Palladium is not like gold and silver. Platinum is slightly less like gold and silver. And so, and you can, if you go back and look at the fundamentals, they're different. Precious metals, silver tends to have, and gold tend to have more psychological elements to it, quasi-currency relationships, whereas palladium and platinum have more economic relationships involved. So, and the supply is a whole other issue. But there you go. That's just an example of what we're looking at. All right, and you can see this chart shows the percentiles. You can see here in the platinum versus gold, these are the correlation percentiles. The range between the high and low percentiles here, the 5th percentile and the 95th percentile, is relatively tight. But look at this one between gold and palladium. It goes way down here to way up there, and silver platinum is relatively tight, but then look at platinum and palladium. It's really all over the map. Silver, palladium. Okay, so that's really what we're looking at, is how stable are these. So converging correlation, what do? When volatility increases in stocks, for example, correlations tend to increase. We've kind of established that. The diversification effect is reduced. So we know that we have more risk then. That leads to higher risks, and higher risk basically than we would expect in a normal distribution. That's the main point here. So what is the answer? Well, our answer to this is to stress test with the following assumptions. We want to stress test our portfolio construction when correlations and risk are on the higher side of our estimates. So we want to assume, let's just estimate the portfolio that those correlations and standard deviations are higher than on the high side. And then we want to look at our return expectations, and let's just consider that our return expectations are wrong, okay? Because return, by the way, is the hardest forecastable variable. So the highest, risk tends to be, even though it moves a lot, it's not stable, it is less stable than return. And it's more stable than return is. And from a percent change kind of a thing. And same thing with correlation. Correlation is more stable than return, even though it's not stable either. So none of them are stable, but some are more stable than others, and that's the point we want to make here. So let's just assume that our correlation is higher, our risks are higher, and then we completely get our returns wrong. What does that do to the portfolio? If your overall risk budget that you've established is still met with that constraint, then that's fine. Then you probably are doing okay in terms of risk goes. So we're talking about risk right now. So larger returns. So let me just back up a little bit. One of the main reasons we focus so much on risk is because risk has a big impact on how well you're going to do long term. Lower risk is definitely better. And just to illustrate that, this chart here shows that if you have a certain decline, it takes a larger percentage increase just to break even after you've had a decline. So let's just look at an example here. If you decline, for example, 25% in your portfolio, you have to go up 33% just to break even. If you decline only 10%, well, then you have to rise 11%. But if you decline 50%, and by the way, the stock market does that, fairly regularly over the last 50 years, you have to go up 100%. 100%. Now, how often do you see the markets go up 100%? So that's something to keep in mind. That's why risk is so important, especially if you are getting closer to retirement, or if you have to kind of look at what your liabilities are against your portfolio as well as an individual and as a pension or whatever type of management that you're dealing with. Okay, so the key takeaways on this section here of this presentation is that technical indicators should be used to help with expectations related to, number one, your return expectation, number two, your risk expectations, and managing your diversification. And this empowers the portfolio manager to use technical analysis really for concrete tradable actions in a lot of different ways. And I'm going to go through some of the stages in the process on how this can be used at a high level. Okay, so now I want to kind of wrap up part one of this video series. Really what we talked about was how theory and practice are different, and how we have these big market shocks out there that we can actually have some sense of identifying ahead of time, and we can look for clues for common characteristics and how we can actually spot potential risk that's out there. And also we talked about how we have these big disconnects and how markets are not normally distributed, and how we need to adjust how we actually look at our portfolio and stress test our portfolios. And we actually talked very deeply about the common characteristics. So now we're going to be moving on to the next video. Be sure to watch the next video, which is going to be on defining portfolio risk and position sizing. It's really got some interesting things as we move forward with this series. This is Louis Llanes with WealthNet Investments for the Market Call of the Week. If you like what we're doing, be sure to look us up on Twitter. Be sure to follow us and go to our website, wealthnetinvest.com, to learn more about what we do. Hope you have a great day. Happy trading and investing.
If you like this information, be sure to subscribe and follow us on Twitter and Facebook. The market calls are designed for informational purposes and should not be considered investment advice. As always, do your homework, assess the risk, and invest in light of your personal goals.